All right. Hello to anyone watching this. This is the first edition of Crypto and Coffee podcast, and I'm joined here by David Blackstone, Bob Johnson, Yudi, and Cordell. My name is Giordano. I'll be your main host. I currently own a startup called Assetra. So Assetra is basically a digital asset platform that hopes to offer different digital assets to our traders as well as make trading easier to the masses. I guess Cordell, we can start off with you with some introduction to your startup, Vault 42.
Sure, absolutely. Thank you. Good morning, good afternoon, wherever you are. Thank you for joining us. So my name is Cordell Tanny. I am a born and raised Montrealer. I have been in the quantitative finance business for 25 years, primarily as a portfolio manager and an analyst. I've worked for some of Canada's largest financial institutions, having managed a few $1 billion in mutual funds and for private clients. And today I build AI, machine learning driven investment strategies, primarily focused on cryptocurrencies. And, my company today, Vault 42, this is what we do. We are launching what we call vaults and tokenized hedge funds so that everyone can have access to machine learning and AI driven crypto investment strategies.
Nice. You want to go next?
Yeah, I'm Yudi. I'm born and raised in Malaysia, all the way on the other side of the world from these guys here. I'm the community manager and I dabble in some business developer stuff at All Access. All Access, we're creating the infrastructure to tokenize IPs that will allow fans to become co-owners of the live entertainment industry and also allowing artists to take back control of their art. If you want to keep up with what we're doing, follow us on X and join our Telegram to get all the latest updates. Back to you, Gio.
Nice. David, you want to start off too and tell us a little bit about Orschestra Labs?
Sure. I own Orschestra Labs. We have blockchain for stablecoins. We are one of the first to do that. We have stablecoins for every different currency, and we are currently putting up a service for trading between stablecoins, automatic trading between stablecoins. So essentially, you can swap between anyone, you can accept anyone, and you don't have to worry about what anyone else is accepting because it goes through the same system for them. With that, we also have different offerings like multi-chain wallet and other things, all designed to make crypto easier. And these other businesses that we're putting up now are also going to have AI integrations, which allow me to use my research area. I'm a researcher on adaptive AI. Now that is not something that is being used right now, but maybe in the next 5 to 10 years, people will be ready for it. We'll see.
Oh, that sounds good, Dave. That sounds good, Dave. Bob, you also want to give an introduction?
Yeah,
to end
sure.
things off?
Yeah, thanks, Gio. I certainly will. Bob Johnson, I'm the Chief Marketing Officer here at Assetra. I live in Southern Virginia, so not Malaysia, not Montreal. I'm really looking forward to this session.
Nice. I think we can just, start off the podcast and just have like a little nice talk about like AI and just, I guess everyone's trading experience. I think like for right now, like, AI is booming. You have ChatGPT, people using ChatGPT for trading strategies. I think a lot of people are moving towards like AI, seeing as how like it makes like a lot of tasks like trading easier. But like, Cordell, Yudi, can you guys tell me a little bit about like your trading history? What you guys have in your portfolio, if it's not like a trade secret or anything like
absolutely. So, I think when we start discussing a little bit about AI and trading right now, I do think, and because this can create debates everywhere, because people get a little bit, charged up when you bring this up. So I think we do have to distinguish between AI and machine learning a little bit when we start talking about this, because I do think that the way things have progressed, people hear AI and they immediately just think ChatGPT. They immediately think LLMs, agentic AI. Whereas there are so many different kinds of trading strategies or applications for just more, machine learning algorithms that can improve pretty much every part of the trading pathway. So I do think it's important to say that, okay, look, not every single trading strategy needs to involve hiring a team of PhDs to start building out your own custom LLMs. And, there are simpler strategies that just use machine learning. So what we're trying to do is not just focus on the AI aspect, right? Or even just the machine learning predictive aspect. Because when we think about trading, and historically, the trading systems. Let's say you just had one on technical analysis focused on moving averages or something like that. There's nothing really predictive in those kind of systems. You have a signal and you act on the signal.
Yeah.
Whereas the AI ones are trying to make more of a prediction. So when you start introducing the prediction in the AI, you are introducing another layer of potential model risk, another potential source of errors. So I think it's something important that people need to understand. So what we're trying to build is not just simple AI models that always have a prediction. We do try and use even just simplified quantitative strategies that, let's say, focused on a basic signal, maybe it's something new, instruments making a new 52-week high, can even be something as simple as that. So I just like to say, like, not everything has to be the Cadillac of AI when you start building trading systems. You want to diversify and group them together. So the kind of strategies that we're doing is we do have a couple that are AI that are more predictive. In other words, just saying, will Bitcoin go up or down over the next day? Something as simple as that, using classic machine algorithms, more like ensemble models. We don't usually just rely on one model. So it can be an XGBoost combined with a ridge regression, like just for example, those kind of things to come to a final vote for what's going to happen the next day. But some of the other strategies we're running are actually just more traditional momentum strategies and just things that, there's all these alpha opportunities that we have. We don't just try and focus on one thing, on just AI, just this. We try and put them together to build, let's say, a target return profile for the fund or for the strategies that we're building. So, sorry, that was a little bit of a long answer, Gio, but that's just really to tell people that, not everything has to be some fancy, crazy LLM.
Yeah, I completely understand. But let's look at it from like the perspective of someone that's, day trading, someone that's using like the first $100 to start trading, right? Some people can go into like ChatGPT, whatever LLMs or whatever AIs to like, write whatever prompt. Let's say they're looking for like a cryptocurrency, they can start off with $100, like let's say in Solana, some Ethereum or whatever, right? Like let's say, like for your instance, like what do your prompts use? Are they looking back at like historical data, current signals? What really is like intact for like a
Well, for that kind of thing, like historical prices still remain pretty much the main signal being used in the primary, for almost all algorithms, whether it's ChatGPT or something that you're doing on your own. You're usually price and whatever derivatives you have from that price, volume, could be rate of change. But sentiment has become really the dominant one outside of, let's say, if you want to get away from structured data and go moving more into unstructured data, primarily what the LLMs are going to be working on is sentiment, because they have the ability now to scan through every single news article or all the tweets on X and then really distill, are people positive or people negative? So that's been one of the biggest applications in terms of trading signals. I mean, aside from the operation aspect of trading, has really been to focus on sentiment, processing all of, the 10Q filings, the 10K filings off of CDAR, or Edgar, that's what it is in the US, and then going through company earnings releases. That's really what a lot of the focuses of the LLMs have been initially, is just really to parse through a lot of unstructured data to try and find trading signals.
Yeah, noted. What about you, David? How is Orschestra like integrating AI and LLMs in your company?
It's going to start off with agentic systems. The proof of concept was for agentic systems, essentially doing the same thing, using LLMs in order to parse words, because LLMs are token predictors. They're language. They process language, and the same with the other models parsed numbers. And then most people did not know how to relate the two. You have LLMs parse words. Now each word is a token, so they're token predictors essentially. Now with that, what you can do essentially is you can take in what a person says, and then you can parse that out into an intent and have that intent run through a workflow. That is an agentic system. The workflow is the code that was already there, that everyone already knows about, that no one wants to pay Web 2 developers to do anymore. And then the AI is just parsing your words into which one of those pieces of code to run. That's it. It's not some high level thing, though. Every computer scientist, every software engineer that you talk to, they're going to try to hype it up as much as possible. If you look at the papers that they write a 10-page paper to tell you how to add 2 + 2. These are not complicated things. They just come across in complicated ways because that makes these people sound smarter. I am one of these people. In order to write one of these papers, that's very literally what they tell me to do.
I think we've all done that, Dave. I think we've all had to do that at one point or another, right?
Yeah.
Part of the game.
Yeah. What are your thoughts, Yudi? What are your thoughts?
In terms of trading, I don't really have much of experience, but in terms of AI's integration, I think it's only going to get bigger and bigger. Currently, what we're doing is using AI to ultimately judge community sentiment on artists' output. So let's say Kendrick just dropped a new track, it's going to be tracking how that performance is doing on X, and that way it's going to be coming up with an evaluation on our platform. And let's say the fans who contributed to the creation of that album are going to get some kind of a reward for some kind of a yield for staking their tokens into that album and its creation for it. But in terms of trading, I'm very new. I haven't really delved into it. I used to trade like in 2020. I hold some XRP, a little bit of Ethereum and Bitcoin. But I've been looking a little bit more into prediction markets because that seems to be the alpha on Twitter these days. But yeah, I've actually learned a lot from Cordell and Tanny over the last 10 minutes rather than the last couple of weeks.
Oh, thank you. Actually,
Yeah.
David, I have a question for you because I find it a little fascinating also, when using it for the agentic AI, right? And you're talking about really the agent is directing overall, like let's call it the manager of the whole thing. So it's assessing the signal and then activating the various parts of the code that need to, right? So it's essentially just automating the whole decision-making part of the trade signal and then execution, correct? So what I'm really curious about this is, because I know that there's so many other people that are focused on the agentic AI side now, because this is really the thing. Like, in your opinion, because it's early, what is needed to really make this a success and to be adopted, let's say, more mainstream by larger institutions? Because there is a little bit of the risk of letting somebody control all of this. What do you feel needs to be done to really get more adoption of agentic AI for the trades?
There is one aspect of risk that people think about, that is making sure that well, there are two things that I think that I need to dive into. One is that people think that people hear AI, they see that they can talk to the chatbot, and they think, okay, that means it's thinking, that means it's a person, that means it can logic its way through all this stuff. That's one problem. Then the other is that people think, okay, well, if I have an agentic AI, that means I'm giving access to the AI to all of my systems. I'm not sure I want to do that. Now that last part there, I don't think I want to do that part, is the rare part on that. But that is one of the thoughts there. Now, I do say it's rare because you very literally have a guy who fired his software developers, tried to vibe code the thing, gave access to the database to the AI, and then it deleted the database. He learned, like, okay, that's why you don't do that. But this is something where people are going to have those. People are going to have one of those two issues. Either they're going to think that the AI can do everything, or they're not going to be sure that that they want to give it access to everything. Neither of these are ways that you should be approaching the problem. One, don't give it access to everything, and two, it doesn't think. So it is a token predictor. It works very well on its area, and it's a neural network that focuses on words. Other neural networks focus on numbers. You had clustering algorithms, that you had other things like that, and those work very well for what they did. Now you have different applications for each of these things, but over in the West, now here's why DeepSeek works so much better than ChatGPT. With DeepSeek, you have multiple smaller models that each focus on a singular area. That's very much like your brain. You have one part of the brain that works on the eyes, another that works on sound. These are separate areas. But over in the West, we want to do everything in one model. Like, very literally, one model for everything. It has to be Lord of the Rings. You have one thing to rule over them all. That's not how you should be doing it, because that's not even how your brain works. Your brain has connecting systems, different systems that are all connected to work together for one thing. But each of those systems focus on a different area. That's very literally how your brain works. Why are we making AI to do something different? So with that, you want to make sure that these people understand, like, okay, it's not going to do everything for you. We have to hook it into the code. And then Two, you have to make sure that the code does not do everything. You have very defined processes. These go over the areas that you touch on very, very often. And if you have a system there that just requires a last-second approval, like just a blocker, that you have someone come in and just say yes or no on that process. Like, for example, if you're interacting with a user agent, the user is the one who says yes or no. Like, it's my account, it's my money. I want to say whether or not the AI is going to be doing this thing after it tells me what it's going to be doing. You have that process in there, and then all of a sudden, the risk is no longer on you. Now it's on the user. Like, you can't sue the AI, so the risk is going to be on you. Now, this is a way of putting it back on the user. Congratulations. Now you don't have any business risk anymore. So you have effectively, now you're not going to be able to explain the first part to people, but you can do the second part. Explaining things to people is very, very difficult because, like, they're going to have their preconceived notion, then they're going to just align to that as much as possible. So, like, if they think, like, oh yes, AI can think, look at it, I had a conversation with it this morning, very clearly it can think. They're not going to accept what you're saying of, no, it doesn't think, it aggregates information and it spits out what it thinks you want to hear to get you to engage. It spits out the format that it thinks is correct. This is why a lawyer got called out for using ChatGPT in a courtroom, because it was making up court cases because it looked correct. It looked like it was the right format. But convincing people that it doesn't think, very, very difficult. So don't do that. Just do the second part and just add the approvals and add it to the workflows. When they see that it makes their life better, they'll adopt it.
Yeah, so as I was saying, David, right? You basically touched upon the first part of like your argument, where AI is basically, you can either give it full access or no access, right? I think it's kind of black and white. So from my perspective, you can like look at AI as like a child, right? You know, you can see in certain scenarios and you can give it like certain, I guess, put it in certain situations. And then from there, it's basically like trial and error, like training it. You know, some people can give it like historical data with data sets and all that stuff. And then you can like have like your trial and error. I know that, you know, you said about DeepSeek, it's basically like your brain, right? Or you have like different smaller models of thinking. And I completely understand that. But what are your thoughts on like what I just said? Like, you know, for instance, you just give it like certain permissions over time, watch what it does in certain scenarios. And then from there, you can like say, okay, this would be the best thing, or we can test this or back test this.
There are positives and negatives to that. One positive is that yes, you can do that. You can do it over time, especially in a closed system. The negative is that when you have other people that are able to access this, you can't gatekeep all of it. So generally, you want to put around borders, so that way it's not going to do everything. But the more access you give it, the more of a chance you have that someone's going to come in, essentially work the system away from what you want it to do and outside of those borders. This is what people do with ChatGPT. They do it with Grok. They do it with every system with a user input. They try to find a way to get it to work outside of its boundaries. So if they are able to do that, then they're able to get it to do something that with that system that you've allowed it to access that you don't want it to do. So keeping it with an open system, I would say don't do that. Keep the risk on the user. But with a closed system, sure, try it out. Try it out with an environment, go for it. And then if it's working well over time, then go ahead and put it up. You know the information is going to be coming in roughly the same way, and every time. Yeah. You're not going to have to worry about formatting. You're not going to have to worry about people trying to hack it. Go ahead, try that. You can usually cut corners with internal systems. With external systems, not so much. But that falls into one of those things that pop up with development. It's called the principle of least privilege. You only grant the amount of access needed for that person to access and do their work. With backend developers, you don't give them access to the front end code, as an example. Just to the backend stuff, because that's the only that's the only part that they need to access. So principle of least privilege applied to the AI, it would be doing the same thing.
Okay, noted. What are your thoughts also on that, Cordell?
Well, no, I completely agree. I mean, I think, you know, the way David's also describing it, right? This is a big project. We're talking about institutions, right? When we're talking about adopting these kind of things at the institutional company level, we're moving away from somebody working in their basement and just trying to day trade a little bit or stuff like that. When you're doing this organization wide, there are so many things to consider to make a project like this work. It's, everyone's hearing about this. Everybody knows they have so much data. Everybody wants to start doing these kind of things. But a lot of these projects wind up failing. And a lot of the reasons why these projects fail, a lot is because of what David was pretty much just talking about, whether it's failure of the design, giving people access to what they shouldn't have, not having really thought it through. But when you're talking about deploying these things from a large financial institution at scale, you have to evaluate the business case. You have to evaluate all of the other things that go into it, the whole program design, and not just how well this thing is going to do or how much money it could save you or how much money it could make you once it's deployed. So one of the biggest reasons things like this fail, other than, just a bad model or improper design or giving people access when they shouldn't have access, it's really not involving all of the stakeholders from day one. So when you think about this, especially if you're using agentic AI, in this case for trading, which can improve trade execution. So now you have the trading floor, the middle office integrated. If you're doing it also in terms of having clients being able to interact with it or clients being able to use it to direct trades, you have so many different stakeholders that go into it and a lot of different people that can be affected by a project like this. They need to be involved from day one. So you can't run these things in silos. These are the kind of big projects that cannot be run in silos. These projects will fail. These projects will fail absolutely because you didn't get everybody involved from day one. You didn't get solicit input. It's really important to make sure that everybody that will be affected by that program knows about it and is involved from day one. Otherwise, these things will fail. So, especially the way David was describing it, this is enterprise adoption. It's not, like I said, not just one person sitting in a basement trying to trade using agentic AI. There is so much more going on. You would never start by messing around with any of what they call mission critical systems, right? There's your corporate jargon. You start small, you test it out, you learn, and then you scale from there. That's, that's the way I approach these kind of projects. And, especially the way David is describing, they don't think, who do you give access to? It all becomes part of the bigger design of the project and needs to be thought of from day one. Those things need to be addressed from day one. David, I'm sure you agree with that. At least I hope you agree with that.
I'm also curious if I answered the question properly, because like you said, I did go with the enterprise approach. Were you wondering more about user adoption, like global user adoption?
I was asking more about the enterprise side. I think it's actually pretty interesting when we start thinking about, the world that we live in, the access that every individual has nowadays, one, to education, right? So anyone could pick up a course anywhere, do some Python, and become, decently proficient very, very quickly. Then on top of it, you have all the prepaid, there's all the packages prepared in Python, let's say, for even some for trading and stuff like that. So, and especially even the LLMs, if we think about creating, the agentic AI trading system, a lot of it's out of the box right now, right? Pretty much you can go into ChatGPT, Gemini, and write out some code to how do I access, I get my API keys, whatever. And then it's just really about the prompt. So instead of us just going onto ChatGPT's website, putting stuff into it, the ability to just program a Jupyter notebook nowadays to interface with an LLM, it's out of the box. It's really, really easy. So the access for the individuals to do this, it's not very difficult. It's the domain knowledge. It's the experience that you need to have from trading for a little bit and the proper prompts and things like that I think will make the difference for the individual. For the enterprise, there is just so much more going on because of the business case. And, you're just moving away from someone who just wants to make learn something new, make a little money, to an enterprise that could have thousands of people affected by it. They're going to approach these things very, very, very differently. And of course, security, the cybersecurity aspect of it will become incredibly important. And especially when we're dealing in the cryptocurrency space, I mean, we've had some pretty serious high profile, I think, hacks in the past couple of weeks, right? From third-party APIs. So I don't want to name names of any companies right now, but there was a company in Switzerland that had a $41 million hack because of a third-party API. It wasn't the company's problem, it was the API, the third-party provider that had something hacked within it. I read something about even Node.js or something like that. There was a hack on the Node.js network yesterday. So I think another aspect that's going to come into this is also how you're going to protect yourself. And because I think the hacking part of it might be the most serious risk, not necessarily who has access. Well, I guess it's all the same thing. But yeah, that's the way I see it. It's just, the enterprise has many more serious considerations than just the individual.
Yeah. Also, speaking about hacking, but just on a related topic, right? How would you distinguish between algo trading and trading with an AI itself? Just for like the average person getting into crypto.
So, I mean, look, the term algorithmic trading, I think has sort of been, hijacked in many different ways. So, traditionally, algorithmic trading just means having a trading strategy determined by an algorithm. It's mathematical, whatever, rule signal based determining it.
Yeah.
But in my mind, algorithmic trading should mean it's automated, right? Algorithmic trading to me means there is a computer system executing the trades and doing everything for you. So I would distinguish algorithmic more from like a rules-based quant-driven system. That's just me. So a quant system is a system that is using mathematics or rules or signals to determine the trades, as opposed to sitting there analyzing companies, going through balance sheets, going through all the financial statements, and then trying to determine the value of a company. That usually takes a lot longer. It's a longer cycle to determine what's your buy and getting in and out in the trade execution. Quant strategies are essentially just driven by rules, right? It's just driven by a set of rules, whatever your quant strategy is. Algorithmic to me would execute that quantitative-based strategy automatically. So you have something set up in the cloud. That's what the algorithmic is. So now when you start adding in the next layer, AI, well, okay, AI to me is still, algorithmic to a certain degree, because their buy and sells are still algorithmically driven. They are driven by a set of rules that the programmer is putting into it or prompting into it. So it is still algorithmically driven, even if it's saying just find me 10 stocks that have had consistent growth in earnings over the past 10 years, which is a fundamental thing, right? When you start saying that, that's fundamental. Find me companies that have the best fundamentals, but you've still directed an algorithm to find it for you and then automatically execute the trades. That's algorithmic. In this case, that makes use of AI, whether as part of the rules to determine or agentic in terms of executing it. So that's the kind of the way that I would look at the progression and the nomenclature there. Is it fundamental versus quant? And then is the quant real algorithmic, meaning executed by a computer? And then at what point has AI gotten into that whole process? Does that make sense?
Yeah, that makes complete sense, right? Complete sense. I think most people think that, algorithmic trading is like, bot trading itself, right? But there's a complete difference. You have parameters in one, and then the next one, you're basically giving prompts to it just to trade. Just to simplify your answer.
Yeah, I agree. That's pretty much it. And, it's just that I guess the debate is really, well, does algorithmic trading mean that there is a bot or there is some sort of automation to the trading, or is it algorithmic trading just anything that has like an algorithm determining when to buy, like what are the rules for buying? So, I mean, it's a little bit of semantics, but if someone were to come up to me and say, hey, I'm selling an algorithmic trading course, what would I expect from that?
Yeah.
I wouldn't expect somebody just giving me a bunch of rules-based trading systems that I would have to trade myself. I would be expecting to learn how to build a bot, have my signals come out on Telegram to let me know when the trades are being executed. That's what I would expect, but that's me, So I have been disappointed by people calling something algorithmic when all they're doing is showing me how to build a simple momentum strategy, which has been around since 1993. So, yeah, but I'm a little bit of a hardcore nut when it comes to that.
To follow up on that, have you built any of your own trading bots that you've used successfully?
Yes.
Yeah?
Yeah. Well, almost all of our trades right now are done, are all algorithmically, are all executed via API on the trade. So we use vaults, right? So, one of the cool things that we find in asset management right now, these things are vaults. I don't want to necessarily call them tokenized hedge funds, but for intents and purposes, let's call it a tokenized hedge fund. So for me to execute my trades, let's say I have a couple strategies that will run every night, midnight UTC in the cloud, determine whether it's a buy, hold, sell, whatever. And then we use the API through a company in Puerto Rico that then routes the order into the vault, the system of the vault, using VHedge in this case. So it's all done. So, and I get an email, and it's also on Discord. We'll get an alert on Discord showing the prices, showing everything when it's done. So yeah, it's all there. It's all possible. Yeah. And but even doing something like that, it's all in the hands of an individual right now. Anyone could really just create a trading strategy, have the code run in the cloud. I mean, executing it, that's a little bit different, right? I mean, you do need services that allow you the API access, right? So interactive brokers is a great example, right? So anyone can write some Python code and use their interactive brokers account and execute crypto trades. You can do it.
So like when you say anyone could do it, someone with like zero coding experience, fresh into the space.
Well, I mean, you could easily go to ChatGPT and say, this is what I want to do, write the code and tell me what infrastructure I need. There will be a huge amount of trial and error. ChatGPT will make huge amounts of mistakes in it. I would not want to be trading live money in that for a little bit, not until I've completely audited every part of the stack. But yeah, no, I'm like, I mean, it's I'm almost completely self-trained. So, my degree was in molecular biology. Look, I was lucky. I was planning on being a doctor. That didn't work out. So mostly because I fainted during a blood test, and that doesn't look good on your med school application. But I taught myself finance. I've had good teachers along the way, but even with the coding, fine. I was good at Excel. I was good at Visual Basic. Everybody in finance pretty much has to be. But then by 2012, 2013, I started really getting into more. I started R, but the learning curve was ridiculous. And then someone showed me Python. And then I just pretty much taught myself. And then there's enough courses out there between Udemy, DataCamp. It might take some time, but I've never been a professionally trained coder. And, it's just, if you have the will and you have the materials, which everybody has the materials now. It's so easy to get learning materials. Anyone can do this. What's the tough part is getting the experience. It's getting the experience of learning the market, learning when the market is going to knock you down, teaching you humility, understanding relationships between assets and things like that. That's more the art, not the science. But yeah, I firmly believe we're at the point right now that anybody can just pick up some books, pick up some courses, and combined with ChatGPT, you can build a trading system. Anyone can do it. Question is, how good will your trading system be?
That's up for debate. Debate.
So that's the experience.
Yeah. One thing I wanted to ask you, David, right? How would you backtest some of your, like code, right? How some exchanges have like a market simulation where you can just input like that algo trade and to see how well it works over like a period of time, and you can speed up in that market simulation. How would you yourself like backtest it? Some people actually go balls to the wall with it and just go straight into the market and just see what happens. But I'd like to know your 2 cents on it.
On the code side, there are two different ways that you'd want to do this. One is on the code side, and then one is on the environment side. So on the code side, I would generally put in these things called unit tests, integration tests, and what I call scenario tests. They're probably referred to as something else like end-to-end. I think they're called end-to-end tests, but I call them scenario tests. The reason I call them that is because I literally write out the code for a scenario and then have it run through that. So unit tests are just over one function. Integration tests are generally end-to-end. So like when you go from the API, what the user would be accessing on the call down to the database. And then end-to-end is what you would generally have on the environment test. And I could be getting this wrong. I'm not a keyword guy, but it's over like front end to back end and everything in between. Now, what I call scenario tests are the ones where you would write out the scenario and see what happens from that. I did this with the Symphony algorithm. I did this with trying to make sure that, okay, if you had this case that's similar to Terra, where you have this massive crash, then what happens? So you have this massive crash, this amount of volume, this amount of collateral that's required, and all these different variables. They're all defined, and then you go through step by step what's going to happen. That would be what I would call a scenario test. Now you can do that on the code level. You can also do that at the environment level. At the environment level, you have different simulations for things within stocks, within equities, and they have back data for all of this stuff. They also have it for crypto, but where you'd access that, I'm not too sure. So you'd have to go back for all of that stuff. With that, on crypto, if you access indexers, that's where you would get it. Centralized stores for aggregates, I'm not too sure, but indexers are what you go for on that. With the stocks and equities though, since those ones are like directly there, like you've got it with Ameritrade, I'm pretty sure they've got an API access point for it. You can just go back in time and trade over years to see how your algorithm would respond to those. And when you're happy with it, then just move forward with it. At that point, you have a system that you've tested with the different functions to make sure that when they change, they're not going to break. You have something that you've tested on basically end to end on both the back end and then front end to back end to make sure that nothing's going to break on those sides. And then you have based off of the expected input, and then you have the scenario test. So that way you know that over the course of these years that you have the expected output that what you'd have. I would say to try to go over as much data as possible, because you want to try to get as many different scenarios as possible. You want to know what's going to happen in the case of a massive crash. You want to know what's going to happen in the case of massive euphoria. You want to know what's going to happen in the case of some unexpected event, like a company just announcing that they've gone bankrupt. This happened with some car company, Hertz, I think it was, and they were both great opportunities, and then chances to lose a lot of money on that as well. So you'd want to test it against as many different scenarios as possible, but the data is there as long as you can access it. Whether you're in stocks or in crypto, you just have to know where to go.
The one thing I'll say that, because I think David addressed it, especially in terms of the code and the testing of the code to ensure it. When you start dealing with a back test, because I'll address this more from a professional point of view, managing money, and if you're launching a new strategy, what's involved, or even what we have to do to prove our strategies. The back test, almost everybody does their back test incorrectly. Almost every back test I have seen is flawed. I have even had, when I was working as a registered investment advisor, I've had professional companies come in trying to present the new product, and they show me a back test, even though it's not really allowed, and their back tests are horribly flawed. So the reason why most people don't back test properly, first off, when you're developing your strategy, this is not just a matter of finding a set of parameters that work and then go with it. Because then you just fitted the curve, you fitted the data, you're going to overfit. That's not how it works. When you're building these strategies, you have to test out of sample. In other words, you're going to have a set of parameters. Let's say you're using a MACD or a moving average crossover, and you need to find the periods. Is it a 50-day? Is it a 200? So you need to test it out of sample. So at first, what you're going to do is you're going to split your data between a training and a testing set. And then you determine your optimal set of parameters, whether you're using machine learning or not, out of sample. And then that gets tested, in sample. And then you test that out of sample. And that's when you'll see how badly it does. Most trading strategies fail miserably out of sample. Now, the other problem, and that's just the fact, that's just the way it goes, right? Finding a strategy that works out of sample consistently, that's the holy grail. That's what we're all trying to do. But the other reason why back tests are all horribly flawed is because most people will execute their trades at the signal. And that's just not how it works in real life. I have seen so many times on Medium articles, people publishing trading strategies where they assume they're trading when the signal was done at market close. Okay, how are you trading at market close? The market is closed. You have to wait until the next day when the market opens to execute the trade. And that change between the close and the open the next day, that could be huge. That could be huge. So if it's even 0.5% or 0.25%, do that repeatedly for 15 years of compounding, your strategy can lose all of its value, all of its alpha being outperformance. So I've seen way too many backtests where people just execute the trades at the signal. Signal does not equal execution price. So it has to be handled properly. And then think about it this way, even if you trade at the open the next day, what are the odds that you're going to get exactly that price? There's slippage. So you have to account for a slippage from the price. But the other thing is, there's a big difference if you're trading $1,000 or you're trading $1 million. If you're trading $1 million of something that's not liquid, you're not going to get one price. You're going to have to know the bids and the asks, everything that was available. And again, that could cause a difference of even 0.1 to 0.2%. But you compound that over 15 years of a trading strategy, and all of your alpha can be gone. So almost all back tests are terrible because either they use the closing price or the signal price at execution without accounting for when they would actually trade it. What's the slippage? Were there trading commissions involved? And then it depends on the dollar amount that you're trading. So I get it. It's complicated. Most people just don't have the skills to be able to do this. And I'm guilty too. Sometimes I'll just do a very simplified back test and just say, oh, this was the return of the day, so I'll use it. Can't do it that way. And dividends. If, like, I know we're talking crypto, but when you're talking about equities, if you do not include dividends into the strategy, especially to the benchmark that you're comparing success against, that's huge. You're talking about a 2% difference compounded over 15 years. That could be a 30, 40% underreporting of the benchmark. You need to factor in dividends. So there are Python packages like Vector BT is a decent one, that can handle decent back testing. But you'll see that so much goes into it and almost everybody does it incorrectly. And almost everybody's strategy appears to have value when it doesn't.
Okay, noted. One last thing, I think we can we're almost at like the hour mark, but let's talk about using AI for fraud. Because one thing that we wanted to do at Assetra, right, was build like our Assetra intelligence to help people detect like fraud. So say for instance, our fraud bot will like look at like blacklisted wallets, look at certain trading activities on the blockchain transactions, right, and then go from there and like probably block it, right? It's still in like the testing phase, right? But David, Cordell, Yudi, what are your thoughts on like how you would integrate like AI in terms of like detecting fraud, right? Because this can be used for like any and every industry.
David, do you want to go first?
Sure. With any given person, you're going to have a specific number of a specific set of actions that they're likely to take, and a specific set of actions that they're unlikely to take. I would try to fit to those actions as much as possible, and try to get an impression of that person for that. Because if anything is greatly out of bounds, in that case, that might be fraud. That might be someone that is trying to take advantage of that account. There are plenty of different models that you can use for that. There are some that I would prefer. There are some that others would prefer. But you just find a good model for it. You fit it against the data, and then you run against that. You can keep stores of different models. That might be expensive, but I try to find a way to get all of this stuff in place. There are systems that are already in place for that, for fraud. Now you can go with one of those. They are using AI. That you'd want to find one that is using a strategy that you agree with. Getting them to tell you about it might be a little bit difficult, but you want to try to find that. If you're going to implement your own, trying to make models that fit towards the user's profiles. You can do that with aggregating profiles and such, but you want to make it scalable. So you have to try to figure out scaling problems. In my case, in the case of the example that I'm giving, fitting multiple people to the same model where it's very, very similar would likely be the way that I would try to scale this. In this case, clustering algorithms are probably the way to go, probably the way that I would go. That was used for other things like targeted sales, way back in like the early 2000s or something. Like there's an example with Target and sending advertisements over to a girl that was pregnant, and her father didn't know she was pregnant, so he came in with this whole fit, and this made it to the news because they knew before he did, and this is just based off of what she was buying at the time. So they were just matching activity to expected user profile, and then moving based off of that. A lot of people are going to end up in the same clusters, which is why you have social networks that take certain actions based off of certain user activities, and those are going to be with recommendations to certain things. In this case, you're not doing recommendations; you're doing flags, but it's essentially the same thing. User action leads to this result in the code. On that, with what Cordell was talking about, this is still applicable here. With AI, you want to have a certain amount of, or in any testing really, you want to have a certain amount of the data that's set aside for the fit, and then a certain amount of data that's set aside for the test. Do not go with 100% accuracy, because 100% accuracy means that you are fit to this data specifically, and anything outside of that is going to be off, completely off, pretty much. So don't fit to 100%. Don't do that. More like 80 is the recommendation that I was given when I got started, but go with what you think is the best fit.
Okay, because let me just expand that, because you just basically said like there's no one size fits all. Certain people have like different budgets for trading. Some might trade once a month, some might trade once a week, right? And so like you have to like train the AI to like look at this in a certain kind of way, because like say for instance, someone just trades like 100K as their first trade. That it's going to look very suspicious compared to like someone that's trading $100 a week, right? So technically, I guess you have to like edit the parameters a certain kind of way. Like let's have like a typical trader, right? They're trading like once a week. That doesn't necessarily look I guess too fraudulent for like the average order book, right? But if you have like a big trade, it's kind of looking like a certain kind of way. But basically, to I guess simplify what you said, you're basically saying that there's no one size fits all in certain criteria for fraud.
Yeah, but on that, let me dive into how these models work a little bit.
Yeah.
So if you have a two-dimensional plane, you have this data versus that data. Let's say age versus amount of money. Okay, well, you have some amount of money at some specific age that's going to be an indicator of fraud in most cases. Now you're going to have dots along the different axes here, and that's going to make a certain curve. What AI is going to try to do is going to try to find the lowest point within that curve. Now, it may be very good at that. It may find the absolute lowest point. That's unlikely. What's more likely to do is it's going to find one of those localized lowest points. But each of those localized lowest points can be useful for other things. You don't always need the global one. You just going to try to find one of those lowest points. Now, when you move that out past a two-dimensional plane into multi-dimensional planes, that's 3 or greater. This is where we're moving out. This is where we're moving out into calculus, like those classes that no one wants to remember. Now, with that, instead of a line, what you're getting is something more like a net, a sheet. Now, with that net, you're still going to have low points. You're still going to have dips within that netting, but it's going to be a little bit more complicated. Now, you can imagine a three-dimensional. Plane. You can't imagine a 4, 5, 6, 7, or higher degree dimensional plane. Like if you have 100 different dimensions over that data, the AI can figure it out, but it's going to be very, very difficult for you to imagine it. So just with the imagination, stick to 3. But with the AI, it's going over age, it's going over gender, it's going over amount of money that you spend on a given day over the last 100 days, let's say. Whether or not you own a Lamborghini, whether or not you live in Spain or versus the Mauritius Islands. It's going to have many, many different aspects to that data. And each of those aspects of data is going to be a dimension. And over that, you're going to have this sheet. You're going to try to find those localized minima, like those low points. That's where your data is coming from. Now, any one of those points that you're identifying is what you're trying to find there with a clustering algorithm. You're trying to find, okay, this group of people with this personality, with these aspects of dimensionality, they're going to, this is going to be their likeliest case for fraud. Like this low point is going to be their likeliest case for fraud. So that's what you're trying to find there. Now, there are multiple different algorithms. I like clustering algorithms. I like neural networks. I like things like that. I never really got into regression systems and others. But each of these have their own use cases, and I diverted over different use cases. You want to find a model that works for you, that works for the problem, and that works for you for this problem. Now, using that explanation of how this stuff works, you do have all these different aspects of the data, but just feed it into the model and make sure that you've trained it well.
Okay, no, Cordell, anything like to expand or any thoughts on the matter?
Well, I think David said that very, very well. I mean, when we're getting back to the fraud, I mean, I think detecting fraud and things like that, the difficulty comes from, and this is a problem that you're going to see in multiple forms of AI, machine learning problems, is that because most cases of fraud are infrequent, right? It's what we call an imbalanced data class. So, 99% of the time, everything's legit. It's just that 1% of the time, if 1% of the time it's fraud, that presents a lot of problems for models. So the question then is, how do you deal with that class imbalance? How do you deal? And there's many techniques to it. So, and I think it's just going to the techniques are getting better and better at addressing these kind of class imbalances and addressing fraud. So, and I definitely think the agentic AI side is definitely, going to be a big improvement over some of the existing techniques, which are more statistical in nature, right? Just upsampling or something like that. So, I mean, it's not really an area that I've had to dive into heavily because I've been more of a trader, more in the finance portfolio construction and just trying to improve the way people manage money by using AI and machine learning. It's just the thing, for people to understand a little bit, because I think it's overall with fraud in general, because, and I think David touched on this by saying the word accuracy. We have to, we all use the word accuracy, but all that accuracy means is how often are you right. So, and if you go down to the classic example of spam, right, and like creating a spam filter. So I could easily say, yeah, my spam filter captures 99% of all spam by just saying everything is not spam, right? Because if the frequency of spam is only 1%, I can say, hey, I'll just let everything through, and then I can say I'm 99% accurate. So, that's why we say accuracy is not the way to look at the majority of machine learning problems, especially when it's a classification issue, meaning you're trying to predict a class, binary, yes, no, up, down, 1, 0, as compared to actually making a numerical prediction. So this is why accuracy is the wrong word, and it's typically the metric that we won't use when building a system like fraud detection, because not all outcomes are the same. And the classic example is, imagine you're a doctor and you've just done a biopsy on a patient. Now, you have 4 things that could happen after this biopsy. The first thing is you tell the patient they have cancer, and they do have cancer, what we call a true positive. That's great. You've probably just saved this person's life. The other hand, you tell them they don't have cancer when they do not have cancer. Again, you're right. This is what accuracy would have measured, was just those 2, but you still have 2 other possible outcomes here. You could have told somebody that they have cancer when they don't. Okay, they undergo the treatment, not great, but they'll live. But then you have the situation where you told someone they don't have cancer and they do. This person dies. So clearly not all 4 outcomes are the same. One of them might have a very different economic effect than the others. So when you start building models, and especially around fraud, you need to assess which one of the outcomes is worst, for you in terms of business. And then you have to optimize the model around that metric. So that's why, we don't use the word accuracy. Accuracy winds up being a very terrible metric to use in very many financial applications, because we are dealing with imbalanced asset classes. The market goes up way more often than it goes down. So trying to predict an up day versus a down day, again, you're going to deal with this kind of problem. So it's just more whether you're doing fraud detection or you're doing, some kind of medical diagnostics or predicting the markets. you're dealing with these class imbalances, and this is the biggest challenge that I would say in the models like this, is dealing with the class imbalances.
Completely agree. Completely correct. You can also look at the intent behind the trade, right? Because you have different order types. For instance, if someone is going to come, I guess, input like a order for $100 5 times, they could also put it in like an iceberg order, right? That also can be like detected as like fraudulent activity in like the first scenario. Okay. And it is not necessarily like, for instance, they could be like a beginner trader doing this or something like, or someone that's just starting out. It's true.
Yeah. Well, I mean, it's there's a lot going on in this world, and I find the craziest thing about it is that whatever I think I know, by tomorrow it's obsolete.
Yeah.
And and that's the craziest thing about being in this business right now. And it's just that things change so quickly. How do we as practitioners, and I even hesitate to use the word expert. I rarely feel like an expert, just because things are constantly changing on me. So I'm in the process of taking a course now for agentic AI in trading, because it's the weakest skill that I have. I've been doing it, but I don't feel like I'm an expert at it. So I think we're as professionals, I think all of us are constantly going to be having to learn all of the new shiny things that are coming out on a weekly basis, just to stay relevant and to make sure that we're doing what's best for our clients and our business. And I really think that is like a crazy thing that's going on, especially Web3. Just combining Web3 and AI right now, it's like the speed at which things are changing, the innovation, it's overwhelming in so many different ways. And I think that's really, one of the biggest challenges that I see everywhere right now, is how do you keep up in an industry that changes at light speed on a given day?
I completely agree. Completely agree. I think we can end off here. That was a very insightful talk about AI, agentic AI, Web3 trading, and all that stuff. Anything else you guys want to say, leaving the podcast? Yudi, David, Cordell.
No, I'll just say this is this is a great project. I really like what we're trying to do here, and I hope everyone out there, starts to see what we're trying to do here is really just dive into a lot of these topics and see where the world is moving to, and share from our experience, share from our insight. We've essentially just put 5 people together that barely know each other, and as an experiment to see, can we share ideas, and what would it be like? 5 people from across the planet that barely know each other. What can we do together? So, for me, I just hope that everyone out there likes it and going to keep coming back to listen to us.